currency and what is purchasing power parity and whether it is useful as a guide to movement in exchange rate. Okay, so this is basically what we try to tackle, what we try to address in the lecture parts. And on your part, for the group presentation specifically, you're gonna link, because there are some new faces, so I want to emphasize that. So you want in the group presentation, you want to link or associate a war event, a given war event to the movement of the exchange rate of a concerned country. And that can be referred to your own country as well. So for example, if your topic is the financial crisis of 2008, which happened in US. So you want to talk about how that event affect the US currency. So specifically, you want to talk about whether the exchange rate of US appreciated, depreciated, or no change. Okay, so it's a very easy topic because those topics have happened like over 10 years ago. So it's a historical event. It's also historical data. So it's very easy to do the topic. Okay, so it's meant to be a little exercise for you. Okay, so because as we mentioned before, when we try to look at the crisis like for the past 15 years or so, we can see it's continuous. It's still happening. So in the near future, for the next 5 years or within the next 10 years, it's likely we're gonna have that crisis again. So it's better that you can get equipped with this kind of knowledge, so that when the crisis happens, you know the direction, you know the magnitude of that impact on your country's currency. Okay, so so this is the main idea. Okay, and then in terms of the financial crisis of the U.S., it can impact the U.S. dollar. It can also impact the New Taiwan dollar because this is a global event, right? So it affects all different markets and all different countries, right? So it's very easy for you to link to the U.S., but also link to your own country. So if you talk about multiple countries, then you will actually enrich your group presentation. So this is basically what it's about. And then what we have addressed in the last 3 sessions on the movement of the exchange rate are really close tied into your group presentation. So this is the main idea, okay? And for your group presentation, basically, it's not really asking a lot. I think per group, it only requires 10 minutes, okay? And then given it's not one person for 10 minutes. It's like 6 people, for 10 minutes. So it's quite easy, right? It's more like it's not really a lot. Okay, so just remember to split to divide the work and divide and conquer. It could be a good strategy for you. Okay, so this is gonna happen next week. Okay, next week. Okay, so this is just a heads up for those people who are new to the class, and also a reminder for those people who have been in the class since day 1. Okay, have a seat. Yes. So this is what it is. Okay. So and it will be quite interesting because through your sharing, you get to know so many different countries. Because when you look at your peers, your fellows, they all come from different countries, right? We have people from French, we have people from US, we have people from Italy, we have people from Thailand, we have people from Vietnam, we have people from different India, different places, right? So it will be interesting and eye-opening sharing experience for yourself and also for the audience because they got to expose to different insights, right? Really country specific. Because when you tell something about your country, right? I mean, how does the financial crisis of 2008 affect your own country's currencies, right? It's interesting because maybe we don't know, right? We only focus, maybe we are overly focused on US, right? And then we forget our own country. For example, if I were to do a financial crisis of 2000 in US, I could talk about the change to Taiwan's currency, whether it appreciated, depreciated, or no change, right? So and through that, you actually get to know other countries' situations and why the change was not as big as you anticipated or as big as it was in the U.S. So it's quite through that kind of sharing, through that kind of exercise, I think it enriches everybody's knowledge. So I think that's good. And consider the workload and the amount of time you require. I think this really is a little exercise for all of you. Okay. Oh, I think I'm looking. Okay. But you can still hear me, right? I think the microphone is on my off, right? I just realized that. Sorry. Yeah, always looking is all right, sorry for the interruption. So anyways, we're gonna have a break every 1 hour. So then during a break, you have a chance to talk to your teammates about your group presentation, how you're gonna divide the work, and also keep an eye on the progress of the other person. Okay, because maybe you have done the work, but then once you don't know what about the others, right? So just and it's happening next week. So and I announced that in day 1. So you had the 3 week prepared preparation. I think that's why we have some people from office to take a look at the equipment. Okay, it's working out. Okay, thank you very much. All right. Let me check. Good. The sound. The volume good enough. Yes. Can everyone hear me? No? Okay. But without microphone, you can still hear me, right? Okay. Well, we just go with that for now. Now, given a break, we can start. Thank you. All right. Sometimes we have the battery low issues, and that's why last time we changed the battery. But all right. So this is our agenda for today's session, and also for the next week's session. Okay. And certainly you will have a break, about 10 minutes, and in 1 hour, so you can talk to your teammates about the progress so far. Okay. And just make sure that if people need the helping hand, just to try to give out the okay. So all right, so that's what we're gonna do, and then and then you might wonder why we have 2 weeks for those newcomers. What you might wonder why we have 2 weeks allocated for the presentation is because I don't want to give you the time pressure, right? I mean, we have like 4 groups, right, in this class. And I don't want to say, oh, okay, we're gonna finish all the groups, right? And then you will have a little time pressure and stuff. And sometimes so I just want to release that pressure from you. That's why I don't set a time. I don't set I don't set the expectation we have to finish all the groups, right, in one session. So basically we just do our best to finish the groups, and then for those groups the group could not have time or chance or opportunity, and then you can just wait for the following week to continue with the presentation. So that's the main thing here, okay? And then so basically it's 10 minutes. So that's like a 4, like it's a minimum that you can talk about for like 6 people, right? And then if you don't go more than that, I think it's okay, because you might be talking about the U.S., you might be sharing with the insight from your country-specific experiences. So So as I mentioned before, it's like when you go with your, you invite your friend to sing in karaoke, and then some people they really like singing, they just keep singing, right? So that's why. So I just set a minimum of 10 minutes, and but if you have more to share, feel free to do that. Okay. All right. So as I mentioned in the beginning of today's session, is try to lay the foundation for you, so you have enough sufficient knowledge to do the full presentation on the foreign exchange movement. Okay. So basically, last time we have talked about let me see. We have talked about the direction and also the magnitude of the appreciation or depreciation. Okay, when we talk about the movement of the exchange rate. Okay, and then we talked about when we are interested in the U.S. dollars, what's the formula look like? Okay, and then we also talk about when we are using the direct quotes, and then we are focusing on the new Taiwan dollar, what will be the formula look like? Okay, and then we mentioned that using this kind of formula, you can find the movement or changes to the exchange rate for one country versus the other, and then so just be aware of whether you are focusing on the numerator of the exchange ratio or the denominator instead. Okay, and then other than that, we have done some examples, like using the Mexican peso and US dollars, right? And to calculate what would be the magnitudes of the change to the US dollar to the Mexican peso. Okay, so that's like a extended exercise that we have done together, right? And then we have done some examples, like with the Great British Pound versus the new Taiwan dollar, right? And then to find the direction, whether it goes up, it goes down, right? And in the other word, in layman's term, it's like whether the new Taiwan dollar appreciated or depreciated, right? And then other than that, we also talk about the magnitude of it, how to find the magnitude for the new Taiwan dollar or the US dollar, something like that, okay? And then of course, you can use that in your own group presentation, right? For example, if your topic were financial crisis of 2008 in the US, then you can tell us what was the magnitude of the change to the exchange rate for the US or for the new Taiwan dollar, right? So you'll be able to do that since we have done the formula and the knowledge last time, okay? And then we also have some extended example with the Japanese yen and the Taiwan dollar, right? So we try to get you familiar with, the math part of the internet of the global business management and also international finance, right? And then this is the magnitude of it, okay? So and then we also talk about the situations when the currency depreciated, right? We lay out the 4 common causes, right? Do you remember any of that? Okay, for example, can you give me one example? What will cause a currency to depreciate? Any volunteers? Did you have any suggestion?
Lower demand for the goods and service.
Yes, that's correct. Okay, and the reason being that if you don't want to have any services or goods from the U.S., right? It's less likely you would demand the U.S. currency, right? And then if you don't want to convert, the U.S. currency, and other people they don't want to convert the currency as well. So the demand of the U.S. currency will go down, and therefore will make the U.S. dollars more likely to depreciate than appreciate, right? That's good. Anyone can give me a second example?
Inflation?
Yes.
Political instability.
Yeah, political instability. Okay, so last time we have talked about I think last time we have talked about the the Brexit, right? The UK is withdrawn from the European countries, right? And that is a good example of political instability. So what happened to the euro, right? What happened to the Great British Pound, right? So that's the political instability. That's a good example.
Low
Yes.
interest rate.
Excessive money supply.
Yes, the inflation. Okay. So basically, when government print a lot of money, right? There's no free lunch, right? In the world, right? If your own country is running, is having high debt, so and then the country start printing more money, right? What do you think about other countries' expectation on your country's currency, right? If you print a lot of money, so that will make your currency, more valuable. Does it make sense to you? Not really. So inflation will actually do the opposite. It will make the currency depreciate, right? All right. So basically, thank you very much. This shows that you have paid attention to last week's session. Okay. So other than that, I think the first one is about the interest rate. Okay. So I think in the class we mentioned about, what's the interest rate in US? What's the interest rate in Taiwan? Right? And we mentioned that in the US it's 4.5, and Taiwan is 1%. So you can see there is a differential of 3.5. So sometimes that provide people incentive to move the money abroad, right, from Taiwan to US, because having the same amount of deposits in the American banks, that will earn more interest than the same person can then earn the interest in Taiwan, right? And because of that, will actually cause the higher demand for the US currency, and therefore will make the US dollar more likely to appreciate than depreciate. Okay, so good. So they are the four common the causes of the currency to appreciate or depreciate. And thanks for your attention to in last session. Okay. And then we also talk about the cross exchange rate. So basically, it's an implied rate. It is used that when we don't know an exchange rate between Taiwan and a third country. Okay, so but because Taiwan has a relationship with US and US has the trading relationship with so many different countries, right? By having one and the other, we can multiply the rate to be able to get another implied exchange rate between Taiwan and that third country. Okay, so and for example, like we know the US and Japan are close, so there is an exchange rate. We know the US and European are close, so there is an exchange rate. But then for the Japanese and Euro, let's assume we don't know it, right? And we can sort of imply it, right? We can sort of infer it by multiplying one ratio, exchange ratio with the other. Okay. All right. So this cost exchange rate or the implied exchange rate is quite useful, as you will see later in today's session. Okay. And then we also talk about the spot rate and also the forward exchange rate. We mentioned those basically the numbers we have written on the contract when we try to deal with other foreign countries, other foreign companies in other countries, right? And then the spot rate is normally referred to the time when the trade is settled within 2 business days. And the forward exchange rate refers to the trade settlement that is beyond 2 days. Okay, normally we settle in months, like 3 months, 1 month, or maybe 6 months. Okay, and then we also talk about the bid and ask rates. Okay, and then we talk about how we can infer the ask rate and then the bid rate. Okay, and specifically we can put that in together. That what we call the bid-ask margin or bid-ask spread, and then it reflects the transaction cost or the risk perception associated with that exchange rate. Okay, and then we have talked about some examples with 6 currencies, like ranging from US dollar, Hong Kong dollar, British pound, Japanese yen, Australian dollar, the Euro dollar, right? And then we have the exercise to see which currency will have the higher bid-ask spread, right, in percentage. And then we noticed that the Japanese seem to have a bigger one, the US seem to have a smaller one. And then we discussed that maybe is referred to the liquidity, because the US is easy to find the next buyer of the US dollar, right? Maybe 10 years ago, right? Now the situation is a little bit different, okay? And then for the Japanese yen, because it has so many stimulus, plans for to boost their economies. So people are not sure whether it's effective, like this time, compared to last time. So the risk perception for the Japanese yen is a little bit higher than the US dollar. And that's why you can see the bid-ask spread is a little bit higher than the US dollar, okay? So, and I also mentioned that this kind of variable, like a bid-ask spread, you can use that to do your thesis, right? It's interesting that you can compare across the board, like to check which currency is considered to be most risky, and or which currency to be least risky. Okay? And other than that, I think we have talked about the nominal exchange rate and the real exchange rate, right? And we mentioned that the economic realized that the inflation is important, because when you have high inflation, it just means the commodities prices, right? It's increasing higher than the increase of your salary, and that's bad for your purchasing power, right? So and it's also bad for a country's exchange rate and also the economy. Okay, so economists suggest that it's important to factor in the inflation, and then once you factor in the inflation in your exchange rate, then you have something called the real exchange rate. Okay, so this kind of rate has been adjusted for the price changes occur in two nations. Okay, and then I think we have talked about the formula, how to factor in those inflations, right? For example, we talk about the spot rate, which is the nominal Mexican peso per US dollar, right? And then we assume the MEP is the Mexican CPI, Consumer Price Index, and whereas the P superscript, the USD, is the US CPI. So with that, we can use the formula, right? And then remember to put the ratio there for the CPI. So put the foreign one in. Imagine that you are the US resident, right? So to put the Mexican one on top of the ratio, okay? And then the US one at the bottom of the ratio, okay? And then multiply that, then you got 14, okay? Which makes sense, because right now it's about it's 50, so it's 15 Mexican peso per $1 US, right? So when the US has higher inflation, right, then the US value goes down, right? That's why 1 unit of US dollar can be exchanged for fewer units of Mexican peso, right? Okay, so now you have the tools to factor in the inflation, right? And then we also talk about this kind of exchange rate can change over time, right? So, and for example, in 2008 versus 2009, okay, so how can we deal with it? So we have to make the base year, okay, for both countries, right? Let's say 2008 is the base year for the US and also for the Mexico, right? Then we just make the 100 for both, CPI index, 100 for both. So we can find the real rate to be 15, right? And in 2009, right, we just have to factor in the CPI, then we can get the new rate, right, between these two countries, which will be 14. And then if you want to talk about the USD, the magnitude, right, of the magnitude of it, then we just have to take the 14 minus 15 divided by 15, then we got minus 8%. Right? I think this is something we have done before, right? So this is just a recap for you, okay? And then if you want to focus on the Mexican peso, then we just have to take the 15 minus 14 divided by 14, then we can get 8.8%. That's the real appreciation of the Mexican peso, okay? contrast to the -8% real depreciation for the US dollar. Okay, so that's how you can do the magnitude in all different contexts, including the nominal exchange rate and also the real exchange rate. Okay, so now you know how to factor in the inflation, the price differences between two nations. Okay. All right. So and then I think last time we also have done some additional exercise, right? And then so at the end, basically here is that we talk about the purchasing power, right? So and we also discussed about that. And then so in this case, that based on the spot rate, we identify there is a gain about the 159% gain in the purchasing power of the Mexican goods and services for the U.S. residents. And because the U.S. suffer from greater inflation, so we would expect to have a loss in the purchasing power for the U.S. residents, right? And then especially we identify the magnitude of it, so it's 107. Okay, so if you just to aggregate these two numbers, then you can conclude at the end, or overall there is a 35% gain in the purchasing power for U.S. residents, right? When they purchase the Mexican goods and services, and overall there's a 26% loss in the purchasing power for the Mexican residents. Okay, so how do I get those numbers? Right? Remember, like when we try to do the exercise, we try to find a real appreciation for the US dollar, right? So we can find out it's 35%. That's how I get those numbers, okay? And because it's real appreciation, it shows the real increase in the purchasing power, okay, for the US residents, okay? All right, so I think we kind of, in the last session, we sort of finish the content up to this point. All right. So now today's session will continue with the discussion of so many interesting, topics in the foreign exchange market domain. Okay. So we're gonna talk about the topic called the effective exchange rate, short for EER. Okay. It's a measure of weighted average value of a currency relative to a selected group of a currency. So why do we want to use the selected group? Because there are so many countries in the world, right? I mean, the major, most commonly, currencies, I think is more than 150 currencies, right? When you try to exchange the dollars at the airport, but then there are far more numbers of the countries in this globe, right? But then we cannot try to, and so there are times when we are trading with our partners, right? We will try to list the top 10, okay? And those top 10 becomes our most important partners, right? For those people or the countries we never trade with, right? I mean, we don't use that in our, when we try to gauge the value, the general value of our currency, right? Because if our value is stronger than our peers, right? That's the correct way, right? I mean, if you want to see how good you are, right? You compare to your groups, right? You don't compare to your grandfathers, right? It's because different generation, right? You compare to your peers that you have direct trading partner with. So in this situation, is like the concept is that you want to have a basket of the countries who you are most trading with. For those you don't trade at all, you don't need to take that into consideration. And if your value is stronger than your peers, it actually makes you stand out. Okay, so that's very simple concept. Okay, so for the economists, they use that to measure their currency's general value. Okay, so basically this EER includes only the most important currencies for your own country. Okay, and the change is measured from the base year. Okay, so we still have to change. We have to still look at the change. Okay. And the weight place greater emphasis on more important currencies in the currency basket. Okay, so normally you are talking about the total trading value, including the export and import. Okay, so the expected exchange rate provides a broader measure of a currency's value against the basket of several foreign currencies. So we have the nominal one. So that's for the near. NER is not adjusted for inflation, while the real effective exchange rate adjusts for the inflation differences between trading partners, indicating the real purchasing power of a country's goods and services in the international markets. Okay? So the effective exchange rate refers to the weighted average of a country's bilateral exchange rate against the currencies of selected countries. Okay? So it measures the average value of a country's currency relative to the currencies of its major trading partners. Okay? I'll give you some examples. Focusing on Taiwan pretty soon. Okay? So when the nominal effective exchange rate is expressed in index form, it's called a nominal effective exchange rate index, or the near index. When the price indexes of different countries are taken into account, then the resulting effective exchange rate index called the real index, and the real effective exchange rate index. Okay. So to construct an EER, we must first pick a set of countries we are most interested in, and next we must assign the relative weight. In the following example, we weigh the currency according to the country's importance after trading partners. Okay. So basically, the step is to select a basket of currencies. Okay, and then so most of the time we are focusing on the totals, the sum of export and imports. Okay, going in or going out of Taiwan. Okay, and then we calculate the weight of the exchange rate in the currency column. Okay, and then basically we select a base year, right? So you want to set maybe 2020 as the base year, and then the current year will be 2025, right? And then you can calculate the relative exchange rate, and then you can compute the effective exchange rate index. Okay. So in Taiwan, back in 2000, okay, so we have about 14 currencies in the basket, and it's ranging from the US, the Euro, Japan, the UK, Canada, South Korea, mainland China, Hong Kong, Singapore, Malay, Philippines, Thailand, Indonesia, and Australia. Those are the countries we assume Taiwan has the strong and most frequent trade relationship. Okay, and in 2005, we update the list to include Vietnam. Okay, so right now in the basket we have 15. Okay, but then when we do the calculation, of course, we're not going to do 15, right? So it will require a lot of computer power, right, to do that. But then I just want to give you the simple concept of that. Okay, so if we create an effective exchange rate for the U.S. that included only the Canadian and the Mexican peso, we could weigh each currency